Welcome to a special edition of Bloomberg Open Interest. We are live from Bloomberg Invest in downtown Manhattan. I'm Matt Miller.
I'm Dani Berger, and we're gathered here with the most influential voices across asset management, banking, and private capital. And what a day to be having this conversation. It's the two most dominating stories, what impact war has on these markets and the fallout from private credit.
Yeah, absolutely. And we are seeing a bounce in optimism as a couple of stories hit the tape over the last few hours. Number one, a New York Times piece that says some intelligence officials in Iran have tried to reach out through back channels through a third country to the CIA in order to give themselves and the U.S. an off-ramp in this war, and a story that President Trump said not only will he escort ships, the U.S. will escort ships through the Strait of Hormuz, but that they will ensure that traffic.
The thing, though, is both of those are so flimsy. We don't know through what method and means if Trump can actually have insurance for those ships going through the Strait of Hormuz. And two, to your point, in the New York Times article, the U.S. officials are saying, we don't know if there's an off-ramp. Who is there even left for them to negotiate with?
Right. Well, and President Trump has said as well that the people that he would have wanted as number two after the Ayatollah or number three, the U.S. and Israel have killed. So there's not many people left to take over leadership there.
A lot of important conversations to be had today. We're going to have some great voices. We're going to hear from Yie-Hsin of State Street, Julie Solomon of Ares, and Marsh CEO John Doyle. And one you don't want to miss, Marathon's Bruce Richards. Plus, I'll be having conversations with HPS CEO Scott Kapnick and KKR co-CEO Scott Nuttall throughout the morning.
Yeah, those will be on stage here, but we'll bring you those conversations live again. We're at the Bloomberg Invest Conference in downtown Manhattan. Day two of this conference that has really, in some instances, moved markets. Let's take a look at what's going on right now in terms of risk. S&P futures bouncing a little here, a third of 1% the gain after closing down, I think not even off 1% in the cash trade.
No, down 9/10
yesterday. Exactly. NASDAQ futures down 0.5%, so up 0.5%, so even a bigger bounce for the tech stocks. But of course, they have gotten hit harder, and in some cases, like memory chip manufacturers have been reeling. NYMEX crude is right now down about 0.6%, but still pretty punchy at $74.08 a barrel. The 10-year yield at 4.07 has stayed pretty much in that range after coming up over 4.1% yesterday. I just want to point out, Dani, the recovery that we've seen in Europe has been much stronger. Obviously, the drops we saw there yesterday were deeper as well. But the Kospi in Korea down another 12% overnight after, I think, a 7% drop in the previous session. So this is a market in which a lot of investors are highly leveraged. Yes. And those memory chip manufacturers like Hynix, like SanDisk, have been selling off. You can see the Bloomberg Dollar Index pretty steady at a little over 1,200, and Bitcoin coming back 5% at 71,000.
It's just breathtaking, the turnaround we've had this morning on just thin amounts of news. And we're going to talk to Tyler Kendall about it in a moment. But in the meantime, some of the stocks we have our eye on, Nvidia rose nearly 2% at one point as stocks turned around positive this morning. It's up 1.33%. Also to note, billionaire Lee Kogan bought 1 million shares of Nvidia yesterday. He believes AI is not in a bubble of Tesla billionaire fame.
Yeah, that interesting argument continues. Right now, Apple is announcing new products after hiking prices for upcoming models of MacBooks. That on the back of rising memory chip prices. We're going to give you more on that with our memory chip guru, Ed Ludlow, in just a moment. But it's really the reversal in risk that I think is the top story this morning.
It is, and it reversed after a report that Iran intelligence officials had indirectly contacted the U.S. to discuss ending the conflict. Defense Secretary Pete Hegseth addressed the public in the last hour.
In under a week, the two most powerful air forces in the world will have complete control of Iranian skies, uncontested airspace. The Iranian Navy rests at the bottom of the Persian Gulf. Last night, we sunk their prize ship, the Soleimani. Looks like POTUS got him twice.
Bloomberg Washington correspondent Tyler Kendall joins us now from the White House. Tyler, it was this New York Times report that seemed to turn around markets. What did we learn from it?
Yeah, hey, Dani, good morning. Well, the New York Times is reporting that operatives in Iran's intelligence unit reached out to the CIA through a third-party country's spy unit to talk about the potential for negotiations just one day after the attack started. However, that report does go on to say that U.S. officials are skeptical that either the Trump administration or Iran is really ready for a diplomatic off-ramp. Now, President Trump himself had said over the weekend that he would be willing to negotiate with Iran's transitory leadership team, but then just yesterday he said that it was, quote, too late. I'll also point you to the fact that we heard from Oman's foreign ministry on Sunday, one day after the military campaign started, saying that Iran was interested in, quote, serious efforts aimed at de-escalation, but then we had Iran's security chief come out and back down those reports. So there's a lot of open questions here about whether or not there is this possibility for a diplomatic route, because we heard these U.S. officials earlier today really doubling down that the military campaign will be sustained. Secretary Pete Hegseth saying that they are, quote, just getting started. We are accelerating, not decelerating. One of the biggest questions here, Matt and Dani, is what leadership in Iran is going to look like. I was there in the Oval Office yesterday where President Trump said that one of the worst potential outcomes would be if new leadership was, quote, just as bad as the regime that the U.S. and Israel is working to change.
Tyler, it seems that the reasons the U.S. has attacked Iran are in question inside the Republican Party. There's a bit of a debate there because of something that Marco Rubio said yesterday, that Israel, in a sense, dragged us into it. Now he's saying that we thought Iran was going to attack us first, and the president says this as well. Is there any intelligence that Iran had been planning an attack?
Well, at this point, the Trump administration hasn't provided that evidence publicly to us, though there are these ongoing briefings on Capitol Hill. But as you're mentioning, there has been some disagreement within the Republican Party coming out of those intelligence briefings about exactly what was the thrust of the U.S. starting this military campaign. Now, President Trump was asked about this directly yesterday, and he still maintains that the U.S. was set to do what they are calling this preemptive defensive strike, despite what the Secretary of State Marco Rubio had said about Israel already being committed to such an attack beforehand. So there's still a lot of questions that we need answered here. But Matt, one thing is for sure, this administration appears intent that they are going to continue and to sustain this military campaign until their objectives are achieved. And that's going to be something to watch really closely, since you mentioned Capitol Hill, because while broadly Republicans have been supportive of the president's efforts, we are starting to hear some cautiousness when it comes to how long this military campaign could go on, and the fact that the administration hasn't ruled out putting American boots on the ground.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall there at the White House. And I want to get reaction in markets right now with Bloomberg macro strategist Michael Ball. He's here with us at the Bloomberg Invest Conference in downtown Manhattan. And let me first get your take on the turnaround in risk sentiment. I mean, clearly, we weren't as worried by the end of yesterday's cash session as we were at the top of the session. But it seems today that a lot of investors are hoping for an off-ramp, not necessarily a Trump put here, but an end to this war before we may have expected it.
Yeah, exactly. And I think you guys are right to say these are flimsy. Yesterday was somewhat flimsy as well. It's unclear what the mechanism will be for the insurance premiums to be covered, or even if we have the Navy assets to do this. But yet the market turned around just as oil did, and we saw that both across rates and risk, and with the equity market covering about 100 points on the SPX, moving back into that 3-month range, which is a much more comfortable position when you're looking at the screens to see. Also, to your point, that some of these other stories, like the memory stock stories, have come back off as we saw some dip buying. So the market's doing what it always does. It's going back and forth between greed and fear, and generally now leaning more into the greed side as dips are being bought.
It's not just Iran, though. There are other things happening in the background. And, Michael, I wonder what meets the bar of rising to the surface. Scott Bessent saying this morning that 15% tariffs might kick in. The EU says, no, we think we're exempt. Does the market still care about tariffs at this point?
They will again, and again, it all adds to this stagflationary worry, and that's what this is all about, and this is why risk appetite now has hit another headwind. And effectively what we're waiting to see is how this affects longer-term expectations, not only from Fed easing and other central banks, but the consumer. And it'll take time for that to hit the softer data. But as far as break-evens right now and what the market's telling us, yes, there's a little bit of a shock priced into pricing and to inflation, but longer out, it's still quite stable, and that's giving comfort to basically, again, risk sentiment, which is coming back a little this morning. But again, any headline can knock that off, and we're all sort of just sitting here waiting and waiting to see if anything comes.
The interesting thing is that to see a headline that the EU expects to be exempt from tariffs.
A day after Trump said you were cutting off trade with Spain.
Well, exactly. A day after Sanchez says Spain is not going to allow the U.S. to use its resources in this war against Iran. It boggles the mind until you think about the inflation impact on the midterms, right? I mean, the Republicans can't really afford to have inflation going back up above 3%, too high for too long, and so they may have to pull tariffs off the table.
I would also add that this 15% is temporary. It's only 150 days or whatever it is. And then they're exploring new sections to lean into. That's what they told us yesterday. They're doing a study now. But the market, 150 days, this is not something that we can really price that well because, again, we don't know what's coming next. And the market usually prices a half a year ahead anyway.
Yeah, the tail keeps getting longer, fatter, whatever you want to say. It is a time of uncertainty. Michael, thank you so much for joining us. That is Bloomberg macro strategist Michael Ball. Right now, we want to take you. Apple is holding an event. They're unveiling several new products, including a MacBook Neo that was just announced. Let's get the latest with Bloomberg Tech's Ed Ludlow in San Francisco. And Ed, the background, as we're getting these announcements from Apple, is a memory chip bottleneck. How is Apple grappling with this as they're making these announcements of new products they're putting onto the market?
Well, Neo is not a surprise because there were some leaks in the last 24 hours, but it's kind of contrary to that story. They've come out with a base or entry-level Mac that uses the highest performance processor from the iPhone. So it has the 18 chip as opposed to the M5 chip, which is across the lineup of new Macs. What we had been saying going into this before the Neo was announced is that essentially there's an effective price hike from Apple because across the new range of Macs, they've raised prices from a range of $100 to $200 and also eliminated the entry-level starting point in terms of storage. So you get higher specification, greater storage, but at the entry point being a higher price point. And so very simply, like DRAM is like the working memory of chips, NAND is the flash is the storage, and there is a bottleneck and high pricing on both because the main suppliers and providers of capacity are prioritizing AI data center. The story has been as simple as that. So simultaneously in London, New York, and Shanghai, they are now giving access to the general public to these new products, but that's the backdrop that they're facing.
All right, Ed, we're going to continue to cover this story and look forward to your coverage on Bloomberg Tech as well. Ed Ludlow there anchors Bloomberg Tech and also is our memory chip expert here, as well as all things having to do with microprocessors. Check on markets right now as risk sentiment turns around just about 18 minutes until the opening bell. You can see that we have gains on S&P futures, about 1/3 of 1%. NASDAQ futures are up a little bit more with the gains that we see in Nvidia. Nvidia moving about 2% higher, and that's enough to power the tech-heavy index.
It's just
higher than
so wild to look at the Kospi have its worst decline since 2001, to see European stocks sell off 3%, to see EM carry get crushed. And oil turns around, and U.S. stocks didn't even close down 1% yesterday. It goes back to Solomon saying his surprise that we haven't seen more of a reaction in markets.
Yeah, absolutely. I think it is fairly surprising, but this is a market. These are investors who want to buy the dip.
True.
And I think the Kospi may be a special circumstance because of the amount of leverage. I'm not an expert on Korean investors, but I have been reading overnight that there's a ton of leverage
for sure
in that market. But absolutely fascinating that people are waiting for a Trump put where maybe there isn't one.
Yeah. Well, some of the other movers on our radar this morning, Bitcoin and crypto stocks, they're surging with that risk turnaround, up 7.3% after Bitcoin took a hit yesterday.
LegalZoom was downgraded by Barclays as growth is expected to slow this year and AI risks to certain software stocks mount. We're going to talk a lot more about software throughout this program.
And one I don't think we're going to talk more about, but worth just bookmarking, Abercrombie shares rising as much as 6% when earnings came in line with estimates, but all of a sudden they sink 6% on lower and weakened guidance, or weaker than expected guidance, rather.
Coming up, Blackstone employees stepping up in support of the firm's flagship private credit fund, pitching in $150 million from their own wallets. We'll get the details next. This is Open Interest live from the Bloomberg Invest Conference in downtown Manhattan.
Jamie mentioned cockroaches. I think of this as jellyfish on a beach. I come from northern Spain, and every summer when the jellyfish, you see the jellyfish on the beach, you know, you still go in the water. You're just very careful. And we have been very careful for years, right? We have been on a risk off for the last couple of years. We're very careful. Obviously, there's going to be sometimes you get stung a bit, but when you're careful, it doesn't matter. You can still swim.
That was Santander Executive Chair Anna Botín speaking with me about private credit fears, saying that they're not cockroaches, they are simply jellyfish. Meanwhile, Bloomberg has learned that Blackstone executives pitched in around $150 million from their own wallets to help cover record withdrawals from the company's flagship private credit fund. Joining us now is Bloomberg senior reporter Silas Brown, who's been reporting on this story. Silas, what does it tell us that senior executives had to make this move at Blackstone in order for BCRED to meet the redemptions that it was seeing?
Yeah, I mean, I think the Bloomberg credit team probably couldn't muster up $150 million, $50 million if we were in a similar situation. And I think, look, I'll go back to a point that I made yesterday to you. Like, I think what's going on right now is everyone is simultaneously defending the kind of mechanism of gating and preventing redemptions, whilst also trying their utmost to avoid being the first fund to do it. And I mean, you know, not to go in on Blackstone too much, and like everyone has their own idiosyncrasies, but I think the Blackstone situation is symptomatic of that. I mean, you know, everyone's facing a higher amount of investor withdrawals, and at the same time, no one wants to be the first fund to do what I think everyone agrees to be a kind of sensible thing, which is to limit those withdrawals. So people are trying extra hard to find all manner of ways to avoid that.
Silas, why doesn't someone just say no? That's not what this asset is for. We don't offer that kind of liquidity, and you knew that when you signed up. We're simply not going to breach the agreements that we made with investors in the first place, and you'll continue to get your returns, and you'll get your money back at the end, or whatever the agreement was, but we're going to hold tight.
Yeah, I think that will come. My guess is, if I was a betting man, I would say that in the next quarter, I think people will be. You know, it sort of seems quite likely that people will have to start implementing these withdrawal these kind of gating mechanisms. I think, look, at the moment we're in a kind of febrile time, and you know, there's a lot of volatility in private credit, and I think people are hyper, you know, scared to be the first person to take the headline risk of gating their funds. So they're sort of all of them are in this kind of blinking contest with each other of who's going to be the first person to do it. But I do think, look, the pressure is mounting, and I think, you know, simultaneously people are, you know, Goldman released their shareholder letter and they were defending the importance of gates. I think that's kind of widespread, been referenced in Bloomberg Invest Conference as well, that it's a sort of feature, not a bug. But you know, I think at some point people are going to have to start using this feature and kind of putting their money where their mouth is, so to speak.
All right, Silas, thanks very much. Silas Brown there in London covers credit for us, and I hope at least you could get other teams together to raise $150 million if we needed it. Joining us now is State Street Investment Management President and CEO Yie-Hsin Hung. Great to have you on the program. Have been looking at the work that you've done at State Street, and it's really impressive in terms of the amount of assets under management you've been able to accrue. I think 4 times what you had when you came in 2022. But I wonder what changes now that we're starting to all kind of freak out about the private markets, which is one of the levers that you've pulled. Yesterday, Mark Rowan was on stage with our editor-in-chief, John Micklethwaite, and said private markets are in for a downturn here.
Well, our focus has been primarily on the public markets and this convergence of private and public. And with Apollo, we launched a series of ETFs starting at the beginning of last year that was really trying to give investors some exposure to the investment-grade private markets arena. And importantly, because we're significant in the ETF space, we wanted to make sure there was good underlying liquidity. And what we found actually in the course of this year is we've provided transparency to those underlying holdings, is that the market makers are showing up. There are active bids on those underlyings. And ultimately, the ETF structure provides enormous amount of liquidity, right? We have a broad range of investors. And so in many respects, there's a secondary liquidity that exists along with the underlying.
So this is an interesting thing. I'm sure you got this a lot when you put the ETF out. Everybody's saying, is there liquidity here? Are we going to see issues of not being able to get your money back? That's not where the issues have arisen. They've arisen in BDCs. Do you think that fundamentally, that the structure, if you are going after retail investors, it needs to have liquidity? Is it an issue to have these traded products that are geared towards wealth and retail investors that are semi-liquid or maybe just have an illusion of liquidity?
Yeah. Well, I think we've seen this with closed-end funds and with BDCs that they do tend to trade on the basis of yield and attract a lot of individual investors. And that's why in many respects we think the ETF structure is a really good structure because it does have such a widespread interest and following. And the spreads that we see in terms of trading activity really provides good liquidity to investors.
What are you hearing from investors? You are, I think, the 4th largest asset manager in the world. And as we enter now the 5th day of a war in Iran, we worry about, fully a 5th of the world's oil and natural gas supplies coming through the Straits of Hormuz. How are investors at State Street Asset Management reacting?
Look, I think everyone's trying to make sense of this. In many respects, I think the length of this conflict is an important factor, and ultimately, what does it mean in terms of oil production and transport? Because ultimately, I think the market is concerned about a prolonged period of time where oil prices are elevated, and therefore it's going to bump up inflation and limit growth. And so I think the reaction that we've seen so far is not unexpected. There's been a flight to safe haven assets like the US dollar and gold. At the same time, because of this worry of inflation, we've seen Treasury bonds kind of trade down. And then volatility in the equity markets, in part because, the direction of travel with inflation is not quite known yet. And if interest rates are higher for longer, that's likely to impact valuations overall.
From what you see, conversations with clients or elsewhere, do you think investors are prepared for more volatility, are prepared for a world where rates might stay sticky, might stay higher for longer? Because we entered the year with hope for animal spirits, a lot of risk buying, and it seems that some of those bets are looking more complicated.
Look, I think the questions that we were getting last year from investors were concerns about the valuations that we saw in the market, the concentration, and the advice that we've been given. A lot of our clients have done this, which is be really diversified across their asset class exposures. In fixed income in particular, I think because there was still a worry about inflation now exacerbated, but the flows have been more in the short to intermediate term. Credit spreads continue to be very tight, and so there's been more of a focus around Treasury holdings and sovereign holdings. And increasingly, we're seeing clients have more of a buffer to deal with this volatility, either cash, and we've seen enormous amounts flowing into cash starting at the end of last year. It continues today, gold, hedge strategies.
All right, Yie-Hsin, we're going to keep you with us through the opening bell. State Street's Yie-Hsin Hung staying with us. A check on the markets as we head to the bell. We're looking at risk bouncing futures higher this morning. This is Bloomberg.
Are we both on cam 3?
Moments away from the start of trading, this is Open Interest, live from Bloomberg Invest in downtown Manhattan. I'm Matt Miller. I thought this was our two shots.
Okay, Matt.
That's our two shot?
They're only a couple feet away.
All right.
Not too bad.
10 seconds ago, and we're looking at futures a little bit higher this morning. We've got a 0.2% gain on S&P futures. NASDAQ futures double that because of the gain in Nvidia shares, and Russell 2000 small caps coming back about 0.7%. In terms of the opening bell, you've got, I guess, McDonald's and the Ronald McDonald House down there at the New York Stock Exchange. They're introducing a new burger. This has nothing to do with what they're doing down there, but they have a big arch burger. Have you heard about this?
No, what is
Bigger
that?
than the Big Mac. It's like over 1,000 calories,
Did someone ask for
65
this?
grams of fat.
Who wants this?
It's apparently very popular.
Seems very
especially
anti-weight loss drug era to do that.
I guess people need a break from that. Down at the NASDAQ, something that people maybe have been asking for. Hyper liquid strategies. It's actually a crypto thing.
I have an issue with this. Their ticker is PER.
Yeah.
It can't be PER and not be animal related.
Right, it should be like
adjacent to cats somehow.
PetSmart kind of thing.
Yeah, agreed.
In any case, it's not, and none of that matters because we're so focused on what's going on in markets on day 5 of war in Iran and day 2 of the Bloomberg Invest Summit, where we're talking a lot about private markets and whether or not we could see a correction here that starts to become a real problem for public markets.
Yeah, but look at what public markets are doing. Nvidia is positive. It's not as high as it was in the pre-market. At one point, it was up 2%. But it does just speak to this general turnaround that's been happening in stocks, that the world's biggest stock is still positive after we saw a massive sell-off basically everywhere else in the world.
Yeah, well, certainly in Korea, right, where these memory chip makers are widely traded, and investors there apparently highly leveraged. The Kospi was down another 12% overnight. Apple has an event. Right now it's announcing new products, including MacBooks at $600 that could threaten the Windows PC market, but I can't think of a time when Apple product announcements will be more overlooked than today. I mean, it's the last thing you care about.
Would have to agree with that. And what we care about is war and the market's response to it, which today is very muted. Goldman's David Solomon has also been surprised by the market reaction to the Middle East war. He called the stock market moves benign and noted it will take weeks before investors understand the implications of the war. Let's bring back in Yie-Hsin Hung, President and CEO of State Street Investment Management. And Yie-Hsin, you know a thing or two about these markets. Have you been surprised by this, I guess not lack of reaction, but the muted reaction we've seen to the events over the past week?
I think the market is really cutting through and wanting to understand what's the implications for oil prices, prolonged elevated levels, and then the impact on inflation. We've been watching ETF flows, and obviously since this weekend, it's been much more muted. But prior to that, it was an enormous amount of flows coming into ETFs. In fact, we were on pace to outpace last year's record volumes. And broadly speaking, if you look at corporate earnings, they're pretty strong around the world, led by the U.S. and emerging markets. And so that has been what we've been seeing with investor appetite. It's broadening out beyond the concentrated Mag 7 into mid-caps, small caps, and especially moving into non-U.S. markets. That's been dramatic.
I think that's an incredibly important point. Just sticking with U.S. assets first, it's hard to judge what's actually happening under the surface just looking at the index levels, right? Because you could see people taking profits from the big winners in AI, in chips, even some of them were in software, obviously not anymore, and switching into the S&P 493 or now I guess the S&P 480 or what have you. Do you see that rotation really happening?
We do, and actually it's been a longer-term trend. The concentration in the U.S. market has declined over time, and then toward the end of last year, near 50% of the ETF flows from U.S. investors were going into international, developed, and emerging markets. And so that trend has continued, whether it's more diversification increasingly, gold continues to see inflows. I mean, we saw 50 billion last year, already 10 million year to date. So a lot of these have been in place, and they're just getting accentuated.
And increasingly, obviously, people are trading through ETFs more than anything else. There are now more ETFs than there are stocks. State Street is one of the biggest ETF issuers in the world.
Which, by the way, I do wonder if that's why we're seeing some of the market behavior that we are. That retail investors and single individual investors are more participating in this market. They're doing it through ETFs. They can more easily buy the dip. Is there almost a degree to which there's a floor under this market because there is so much appetite for products like those that State Street puts out?
Well, we think that the addition of retail investors becoming more sophisticated over time. They've had a behavior of buying the dip. But we've also seen the growth of model portfolios, which, again, I think fosters that sense of being asset allocated as opposed to being too concerned about where the market is, where headlines are.
And, of course, I'm getting a note from a viewer right now pointing out that people have learned to look through these geopolitical events. Your first decision could be your worst decision, right? You don't want to overreact. Right. Are you seeing that as well? I mean, you have a storied career in finance, working at the biggest hedge fund in the world, at Bridgewater, and now running State Street Asset Management. Do you see that behavioral shift?
We do. Across our investor base, it has been much more of a focus around strategic asset allocation, some tactical, but not necessarily taking bets off the table. Because, you know, the corporate environment is still quite good. And notwithstanding, you know, the potential for oil to cause inflation to spike here, we still think over time the Fed should be in a position to be cutting rates. So there are good tailwinds here that augur for investors staying invested.
Just the skeptic in me, and I'm sorry to go here, the skeptic in me just thinks maybe we've just been too conditioned, that we've been too conditioned to buy the dip. And we are talking about war that could change an entire region, that could completely change energy markets. And we've learned to look through geopolitical events, but what if this time is different? If this time is different, Yie-Hsin, what is the hedge? Because we've seen gold, for example, you talked about it moments ago. It's been acting almost as a speculative asset. Are bonds the hedge, even if we don't get cuts? What becomes the ballast in a portfolio when people are willing to continue to put on more risk?
I think it is these stabilizing allocations. And I do think gold has multiple purposes within a portfolio, whether it's a macroeconomic hedge, inflation hedge, US dollar hedge. And of course, central banks around the world have been accumulating more gold as they've reduced their dollar holdings. At the same time, cash is seeing a lot of flows as a result of now paying a good yield, and it's a good place. In the event the market does truly dislocate, there's opportunities to go in. And increasingly, we're seeing hedge strategies. You mentioned Bridgewater. We had launched a strategy along with them, all weather, that also provides some ballast within a portfolio. So demand for these different exposures is growing in an environment that we're in today.
Great to get some time with you. Really appreciate it. I look forward to your panel as well here at Bloomberg Invest. Yie-Hsin Hung of State Street Investment Management. Tonight, Bloomberg Television interviews Goldman Sachs CEO David Solomon. That's at 5:45 p.m. Eastern Time. Definitely tune into Bloomberg Television, or stay tuned to Bloomberg Television for that interview. Check on markets here as we come up to 20 minutes of the cash trade. We're looking at still gains on the S&P 500, 0.2%. The NASDAQ up 0.6%. As the price of Nvidia increases. It was unchanged right at the start of the trade. NYMEX crude.
Oh, it's up now.
Yeah, Nvidia. Or NYMEX crude.
NYMEX crude is up now.
NYMEX crude is up now 0.25%, $74.72. So just gaining about 65 cents from where it was when we kicked off this program. And the 10-year yield holding at 4.07%.
By the way, I wonder if this is what's turning around oil. Iran has now denied the intelligence, the report that the intelligence ministry reached out to the CIA for talks. Recall, that was why the market was able to rally. We said it at the top of the show. It's a thin reason for a rally. Now Iran downplaying those reports. Oil moves higher. but not a whole lot higher, and stocks hold on to their gains.
Yeah, I mean, that's also a thin reason to turn around sentiment. You know,
Correct.
You have a New York Times report, which all credit to them for the scoop, but they're talking about maybe some intelligence officials reaching out days ago to try and save their necks.
Right.
Right? And now some probably other intelligence officials are saying, no, that didn't happen.
I was going to say, we don't even know whether the original intelligence officials are still around to this day. There's so many questions to be answered.
All right, technology is a focus really today, and seeing some relief this morning. Joining us now is Yie-Hsin, Global Head of Technology Research for Bloomberg Intelligence. He's here with us at the Bloomberg Invest Conference, and let's start by talking about what's going on at Nvidia, because memory chips have had ripple effects across this sector now for days or weeks even. What's happening with the world's largest company?
I mean, I wouldn't, pay too much attention to what's going on with the Korea market, because obviously there is a momentum element to.
Oh, but it's so much fun, Mandeep. I mean, not fun if you're losing a lot of money, but it is breathtaking to look at those things.
The country's benchmark index was down 12%. A day after it was down 7%.
It's hard for me to explain why it's happening. Obviously, it's happening. That's a reality. But there's nothing in the fundamentals that makes me believe memory companies are going to see a slowdown anytime soon. And I'm going to go with what Nvidia guided to, for the next quarter. So for me, Broadcom reporting tonight will give a better insight in terms of what the end market demand is. And look, Broadcom plays in that ASIC complex, so they have visibility to Google orders, probably Anthropic ramping up their kind of chip expectations. So from that perspective, the Broadcom print tonight will be a better indicator of the end market demand and how sustainable it is versus what's going on in the Korea market right now.
Broadcom's had a tough start to the year, down 9.25%, underperforming both the S&P and the greater tech index. Can we say, okay, it's great for them, good, it's a low bar for Broadcom. What do they need to do to change around their narrative that they've had this year?
I thought, up until last quarter, everyone expected them to add more customers because, all these hyperscalers want to build their own chips to rival Nvidia. What Nvidia showed this quarter was not only do they have a very high visibility for their GPUs, they're also gaining share on the networking side. Their networking revenue grew 3x. Now, Broadcom is a big player when it comes to networking. So to me, that is a bigger worry for Broadcom on the networking side than it is, okay, whether Google TPUs ramps up or not, which I expect it to, because Google also raised its guide for CapEx, similar to other hyperscalers. So I think there will be upside on the chip side. It's just the networking side is the one that I'm watching out for.
I have, thankfully, Bloomberg clients just messaging in around this Korea move to remind me of a couple of things that I think are pretty important to highlight. Number one, the Kospi is still up 20% year to date after taking such a bruising over the last couple of sessions. Number two, if I type in the Kospi index and put MEMB Go, I can see the weighting of the companies. Samsung is worth 25% of the Kospi. SK Hynix is worth 15% of the Kospi. The next biggest weighting is Hyundai at only 2.5%. So those two companies together are worth 40% of the index.
I mean, look, we had this SaaS apocalypse here. So if you are a fund that's losing money, you do end up sometimes selling up your winning positions. And again, if liquidity can always be a driver of, you selling certain names, even if you believe in them long term, but there are times when you end up selling things that look very good from a fundamental
Things that are up
perspective.
225% over the past year.
And maybe
you might as well
we're
take some profits.
insanely leveraged on it, and you're getting margin calls, and circuit breakers are going off. What an overnight session it was. Mandeep, thank you so much for joining us. Yie-Hsin of Bloomberg Intelligence. Coming up on the show, Julie Solomon of Ares on where private capital is flowing, specifically when it comes to real estate, just getting off a panel about the new economy. We're excited to have her. She joins us right after this break. You are watching Open Interest live from Bloomberg Invest.
I effectively had one dot now for 2026. I basically had 2 and 2, and because they did 3, then I brought 1 dot forward. So that leaves me with 1 dot coming into recent events, so 1 expected cut later on this year. Now with the geopolitical events that we talked about, I just need to see. We need to get a lot more data in.
That was Minneapolis Fed President Neil Kashkari speaking here at Bloomberg Invest on his rate cut outlook for 2026, saying now he's unsure whether we'll get that 1 cut that he had penciled in. Joining us now for a look into real estate is Julie Solomon, partner and head of real estate at Ares Management. Julie, fresh off the panel, thank you so much for joining us.
Great to be here, Dani.
There's this big question in markets happening now. What does the rate path look like? Because of an outbreak of war, of higher energy costs, that's really getting questioned to the amount that we'll have. How does that impact your outlook for the sector in 2026 if we don't get as many rate cuts as we expected?
It's helpful to first contextualize the impact of recent rate movements on real estate and on the market more broadly, because what I would say is it's actually created quite a bit of discipline within the real estate market specifically. And so if you look at what happened in a higher rate environment, asset values have reset, construction deliveries have declined, and the capital markets are now fairly constructive for real estate. So what happened as the Fed has normalized rates, we are in a period of time where transaction volume picked up. But what it does mean, Dani, is that this next chapter is going to be about driving cash flow, improving operating performance to drive returns as opposed to a lower rate environment. But we think it's created a lot of discipline for us.
Well, what does it do about all of the loans coming due over the next 12 to 24 months? There's already been this idea of can kicking. Yeah. Can we keep kicking the can? What happens when that comes home to roost?
Well, the capital markets have been available for quality cash flowing assets. So we have seen a favorable market, particularly for builders, buyers like Ares Management, where we've been actively participating in the market for a long time now. Where there will be challenges is on assets that are in second-tier markets, lower quality segments of the office market that we talked about earlier. And so, but what we see more broadly is that the lending markets will be friendly.
We talked about this during the commercial break because you're actually not invested in very much office. Before we go any further, tell us about your portfolio specifically,
Sure.
because you've avoided that pitfall and you have other unique holdings.
We sure do. We manage about $120 billion of assets under management, and about 85% of that, if not more, is in logistics and living, sectors that have really strong, durable, long-term demand drivers. There's a lot of resiliency. The balance is in assets that are adjacent to those, like self-storage, student housing. Data centers is a big part of our business too. And so as you think about that broadly, we feel that the current environment sets us up for a real position of growth.
Tell us a little bit more about data centers, because it's obviously a hot topic right now. And, you know, from the private credit perspective, there's a question about how much they're financing. But from a compute perspective, we can't get enough over the next few years, right?
You're right, Matt. We can't get enough. I mean, when you think about it, the demands for infrastructure to support this industry is enormous. And that's why groups like Ares have really been able to step in a meaningful way as lenders, as developers. We have a very large data center development capability that we brought on board with the acquisition of GCP that closed just a year ago now. And the growth in data centers plays right into what we've been talking about new economy investing, right? Which is the property types that are all supporting the way we live, the way we work, the way we're consuming. And so we feel there's a very much interconnectedness between data centers and how we're investing in real estate.
How competitive are these deals? Because this is a sector many have identified. Is it really competitive because everyone loves it, or less because you need the size of an Ares, for example, to actually participate in it?
Like any market where there's a lot of attention, you wind up seeing participants coming in with a varied set of capabilities. And so there is competition out there, but what we've been able to see, and we just talked about this on the panel earlier, is that groups that have multiple capabilities across infrastructure, across the capital structure, energy, which is such a large part of this story too, we're able to provide competitive advantages that give us an edge in the marketplace.
By the way, Matt kind of hinted at your office holdings, which is notably absent from your top calls. What would it take to get back in office? How are you just viewing that sector as a whole?
You want to buy low, sell high, right?
We've been underweight office for probably 15, almost 20 years now. There are a lot of attributes that are interesting from the super class A end of the market, but it's incredibly bifurcated. And what we found was that there were a lot of other sectors that could provide us with much more predictable, much more durable returns. And while values have come down considerably, it's not just about entry point, it's about how do you then drive cash flow from there.
You must still think about it a lot, Julia. Are we ever getting back to 95% occupancy, or no?
Well, as a resident of New York City, and certainly in a company where we very much believe in the work from office mentality, really do believe in the market. However, as investors, we think there are better opportunities out there.
Great having you spend some time with us at Bloomberg Invest. Thanks so much. Julie Solomon runs the real estate business for Ares. Still ahead, we have HPS CEO Scott Kapnick, Marsh CEO John Doyle, and Marathon's Bruce Richards, all on this program. They're all here at Bloomberg Invest. This is Open Interest. All right, happening right now at Bloomberg Invest. Lisa Abramowitz from Bloomberg Surveillance is speaking with the CEO of Temasek, Singapore Sovereign Wealth Fund. You can watch this conversation and all of the others happening here at Bloomberg Invest on Live Go on your Bloomberg terminal. Just type LIVE Go. Coming up in the next hour, Dani Berger sits down with Scott Kapnick, the CEO of private credit firm HPS. That's one we're going to bring you. We're also going to hear from the CEO of Marsh, John Doyle. He's going to join me here on set as we enter day 5 of the war in Iran. And Marathon's Bruce Richards will join us here on set as well. And I'll sit down with him at Bloomberg Invest on a panel as he publishes today on LinkedIn that we could see 15% default rates on highly leveraged software companies. That's an issue we'll delve into with Bruce Richards. Check on markets right now. We have the S&P and the NASDAQ gaining as oil turned to the upside. This is Bloomberg. We are 30 minutes into the trading day. Welcome back to Open Interest. We are live again from Bloomberg Invest in downtown Manhattan. We're gathered here with the most influential voices across asset management, banking, and private capital. I'm Matt Miller. Dani Berger is set to speak in just a few moments with Scott Kapnick, the CEO of private credit firm HPS, as we hear warnings on private credit from this conference. Yesterday, Mark Rowan said maybe entering a correction here. Plus, later this hour, conversations with Marsh CEO John Doyle as we enter the 5th day of war with Iran, and Marathon's Bruce Richards as he issues a fresh warning on software companies, highly leveraged software companies. He said the default rate could be 15%. Now, let's kick off the hour with breaking eco news. Crossing the terminal right now, we've got your ISM services numbers, and I'm looking at a services index at 56.1. We were looking, or the survey had been 53.5, and the last number was 53.8. So a little bit of an improvement there. Prices paid is probably where you're going to look first, and that's 63 compared to 66.6 in the previous reading, 68.3. Now, let's get over to Michael McKee, Bloomberg's international policy and economics correspondent. He's at 731 Lex with the read. Mike, what do you got?
Well, basically, Matt, this is one of those go figure things. The ISM manufacturing index showed that prices paid shot up, and the services index showed they declined a little bit, and it's probably telling us that what we're seeing on the manufacturing side is tariff-related costs. And it was the first of the year, so maybe those start to fade, but we're going to have to see with all the changes in the tariffs. The other things that you want to look at, of course, are employment, and employment rises to 51.8 from 50. 50.3, so that may be some good news. We got a little bit of a disappointing ADP number today, still showing not a lot of expansion there. And then when we look at inventories, they're up sharply to 56.4 from 45.1, and then the question becomes, do you slow down because you've rebuilt the inventories? So the numbers I think that really matter are the headline number and the prices paid number. As you mentioned, the new orders number does rise substantially, 58.6 from 53.1. So the service industries seem to be hanging in there and maybe adding some people, and the manufacturing side of it may be a victim of tariffs, and that may change. That seems to be the view of most Fed officials these days.
Mike, in terms of inflation, when are we going to start seeing signs of war inflation coming through into the market? Because that's obviously what spooked the bonds on Monday morning, and that we've been worried about in these markets ever since.
That will take some time, although this war started at the beginning of March, so the effects it's having on gasoline prices, say, will show up in the CPI and in the PPI, and gasoline seems to be the one commodity that is really moving quickly in line with oil prices. So we'll probably see it there first. Now, the Fed will look through that because they know it's probably just temporary. The issue becomes if it's continues to rise or stays at an elevated level for a while, then it starts to bleed into other areas that use petroleum, like plastics, pharmaceuticals, et cetera, and you see more long-lasting inflation. We could also see consumer sentiment affected by rising gasoline prices. Nobody's going to like filling up at the pump with prices up by about 20 cents since this war began.
All right, Michael McKee, our international economics and policy correspondent. Great to get some time with you. Up at 731 Lexington Avenue, up at the mothership. We are down here at Bloomberg Invest with the most influential voices across markets and Bloomberg's macro strategist, Michael Ball. He's been with us at the conference over the last couple of days. And Michael, what do you make, first off, of the eco data crossing? Your MLive team obviously watching, breaking this live, and our clients can follow that by typing MLive Go on the terminal. What do you make of these moves?
Yeah, at first blush, it looks positive. Obviously, we were worried that we're losing momentum. Q4 GDP showed some of that happening. There was actually just a churn and burn in the underneath, where the manufacturing side and the durable goods and the industrial production was holding up well, but now the service side was looking weaker, retail sales sort of being a gauge of that in some ways. But this actually is a generally positive thing because, again, the price pressures weren't there. The big problem with last week's ISM manufacturing was a big shoot up in the price index, which, again, with everything that's going on, is putting the stagflationary worry in. If we're going to buy into this reacceleration, we need to not have inflation. We need to just have pure growth.
We did see the 2-year yield spike a little bit higher here. The 10-year yield right now at just about 4.8%. What do you make of the risk reaction to day 5 of the Iran war?
Yeah, it's interesting that the Iranians came out and said that we are not in back channel discussions here, and oil barely moved. So again, the market looks like it's latching on to positive things much more than negatives, and it kind of discounted some further strikes we saw in the Gulf. Oman had gotten hit a little bit, or a cargo ship off of the coast there. So what I'm seeing here is greed again coming back in over fear, and that's usually what happens. We have this bout of fear, we take the elevator down, and then we start building steps up, and that's sort of what the SPX is looking like now when I look at levels being built again, with now this 6850 battleground zone being where we are.
You have spent time at the New York Fed. You've spent time also trading, I think, gas contracts,
all kinds of stuff, yeah.
as well as other things. I guess energy is the driver here, obviously, with the Strait of Hormuz being the bottleneck for 20 million barrels of oil a day. How do you see prices right now? Because I know it's at one point on Monday morning, people were like, worst case scenario, we could see over $108 a barrel on Brent.
So interestingly, I see things actually improving today, as you would expect. But what I was worried about, and why I'm saying interestingly, is the liquidity picture wasn't as deep as we thought it would be on Monday and Tuesday, especially in the sort of Dutch gas trading markets where everybody just kind of ran in. But with oil here, especially with Brent, we'd seen, call skew going up, and there was a little bit of a squeeze higher. But that seems a little bit unsustainable if we don't get continual negative news and escalation. And although we are still in the fog of war, we still don't know where this is going, prices should ease back just based on the fact that that implied vol level won't be maintained, and effectively you don't get that premium for being long.
What do you watch for? I mean, obviously, President Trump's comment that the U.S. could escort ships through the Strait, that the U.S. could insure oil coming through the Strait, should and has allayed some fears. But the question is, can we really do a good job of keeping them safe?
Yeah, unfortunately, I think President Trump has sort of sidelined himself. What I'm watching for now is from Iran, for them to actually concretely say, we want to come back to the table. We're willing to give these concessions that we weren't earlier, whether it's about the nuclear program, their missile construction program, production program, and some of the other things that were non-starters before, if that has changed. And as you guys have been covering, we don't really know what leadership looks like there. We don't know who's left. We don't know anything about the structure of how the government's going to be formed. So we need concrete knowledge that there is still a functioning government. It can make decisions for the entirety of the country. And that's effectively what would then calm oil markets, and we would go back down and risk would be better supported.
It's interesting to see investor behavior throughout this, because you might have expected a bigger sell-off in stocks, certainly U.S. stocks. You might have expected a bigger bid for treasuries. Where do you see the dislocations, and where do you see investors just getting more sophisticated?
Yeah, so yesterday was super interesting because there's something called a dispersion trade on, which has been very popular, where you're basically either going to be long the index or long some of these hard assets like industrials and materials and oil, and you're short the services and the softwares, the ones that are disrupted by the AI angst and the anthropic noise that we've been getting for the last few weeks. That trade seemed to come undone yesterday. We had oil stocks down yesterday, even though at the time oil was up 7%. What I'd like to see is that come back in. That's been a huge vol suppressor. It's allowed the indexes to creep higher, or at least stay range bound, because let's be clear, we've been range bound for about 3 months. And that in itself just brings in more participation. That's starting to get shaky yesterday. I got worried, but then we recovered after we had some positive headlines again, and oil came off.
What are you watching right now? I mean, you've got your terminal set up over here. We really appreciate you joining us. You and the rest of the team, what are the indicators that you're watching the most closely?
It's actually somewhat simple. We're just watching oil, and I'm watching actually call skew and put skew, and so I'm trying to think about where positioning is changing under the hood there to see if traders are taking profit, because now they're getting a message that things are going to calm down. I liked what I saw in the Dutch natural gas market coming off a little. At least it wasn't continuing to capitulate higher and get squeezed. And obviously break-evens. I'm like looking at that to lead nominal. So if rates go higher, financial conditions tighten, that's just a massive longer-term headwind. It also, as you know, makes the Fed's job a little harder, because the market's telling them that they're worried about inflation. And when the market's telling them they're worried about inflation, they listen more to, say, the University of Michigan and the consumer center surveys, which can be a little more political and wonky.
Don't they have deeper reserves than these price moves would indicate?
Yeah.
And, I mean, don't we have more oil on the water than these price moves would indicate?
I think again, it was a squeeze because of positioning, and everyone, again, was thinking diplomacy was going to come through. Also, from what I was hearing, we still had a little bit of time. Coming out of those meetings last week, remember, the Qataris were telling us that everything went somewhat well, and we took them at face value. So again, there was a little bit of a squeeze. Markets do what they always do, overprice the fear and the tail risk, and now we're starting to stabilize.
All right, Michael Ball, great to have you with us. Brendan Fagan, Tatiana Dari, your excellent team, all writing for MLive Go. Check that out if you've got a Bloomberg terminal in front of you, MLIV Go. In terms of the broader indexes right now, we do see the S&P 500 up this morning, about 0.4%. So the gains are holding into the session. The NASDAQ up almost 1% here as Nvidia rises about 1%. You can see NYMEX crude has been swinging between gains and losses. We had seen it up to 74.78. We had seen it down to 74. Even right now, we're in the middle of that band at $74.29 a barrel. The 10-year yield right now getting up over 4.08%, but still also holding within range, so 4.0824%. If you look at what happened in Europe, you saw a bigger recovery there, but of course you had bigger losses in Europe over the last couple of trading sessions. So the Stoxx 50, the biggest 50 stocks in Europe, right now up almost 2%. You've got European gas futures that Michael was talking about. They got absolutely crushed the last couple of days, and or I should say the price rose drastically the last couple of days, and they are now coming down to more than 10%, the tune of more than 10%. The Bloomberg U.S. dollar index unchanged at 1,200. And by the way, I look at the BBDXY rather than the DXY because we're looking at the dollar against a wider basket of currencies, 10 trading partners there. And then Bitcoin is interesting today, right now up 6%. So Bitcoin trading up over $72,000 as a measure of risk sentiment. Maybe that tells you a lot, although you've got to wonder what's behind those moves, especially considering the movement that we've seen in Bitcoin over the last couple of days. So investors are first of all, haven't sold off as strongly as you may have expected over the first few days of war with Iran and are now willing to come in and buy the dip. They clearly were doing that yesterday as well, as we closed down less than 1% on the S&P, and they're driving things higher today. You've got a lot of other issues. First of all, here at the Bloomberg Invest Conference, you've got worries about private credit that are spreading. Yesterday, Mark Rowan said he thinks the private markets industry is in for a bit of a correction. We've got Bruce Richards coming on a little bit later. He said he thinks we could see up to 15% defaults in highly leveraged software companies. Of course, private markets are very much more exposed to those highly leveraged software companies than you would see on an index or even in high-yield credit. So we're going to talk to Bruce Richards a little bit later on. You can see Dani walking out on stage right now with Scott Kapnick of private credit for HPS. Let's listen in to that panel.
That feels very pivotal for this market. And I think it's useful to just take a beat, because in many ways your career reflects the entire journey that this market has gone on, heading up the investment bank at Goldman, spinning out HPS from JP Morgan, bringing that back under the fold of another company, BlackRock. Scott, how did we even get to this moment, though, where private credit became the behemoth, the headline grabber that it is today?
Right. Well, good morning, and thank you for having us. And you know, we're living in a moment right now where maybe one of the most significant events in the world for the last 50 years is happening, while we're also talking about private credit. So it's a little bit hard to put that into perspective. But I think you know, from my perspective, again, 40 years in finance, been all over the world with Goldman and JP, and you know, the Western capital markets are going through a real change and evolution now, as you've had sort of the post-financial crisis landscape really settle in. Banks have shrunk. You've got some big banks still very involved in the capital markets. You've got some big, some of the people that were on stage here over the last couple of days, you know, insurance companies and others, and then you've got some fiduciary firms like ourselves and BlackRock and Ares was on stage. You know, those firms are really bringing private pools of capital to grow companies, and with that, there's not enough bank capital in the world to grow the economy, and particularly as governments have leveraged themselves, there's really just not enough capital to grow the economy. And I think you're going to see that wave has been very big in the U.S., very big in Europe, parts of Asia, Australia. I think that's going to continue over the next 30 to 50 years. It's
a good point, because not only are governments very levered at the moment, there are these huge projects that they're undertaking, whether it be Europe wanting to be more self-reliant, be it the AI build-out in the United States. So just how critical of a pillar has private credit, has private capital become for these economies?
Yeah, I think that, you know, again, they're not with the capital expenditure that's going into both technology, AI, as well as the underlying infrastructure. You're not going to be able to do that without private pools of capital. And Dylan, who you just spoke to, is one of the smartest and most aggressive in that. And I think you know, you've got to have people pull that together and help structure things in a way that optimize and make it efficient. You know, so you want equity in that. In order to attract foreign direct investment, you need the capital that comes alongside the equity to help that.
You made the comment to me the other day that I thought was interesting, that not only is this change continuing, but the pace is accelerating. What does that mean if we zoom out 5 years from now? If the pace continues to accelerate, what does this market look like?
Other than our heads explode?
Yeah, that's possible too.
No, I think that we are in a period where change is really evolving quickly, and I think that with with what's coming with AI, and I know Larry Fink and Rob Goldstein wrote an article on tokenization and the impact of that. That's also going to change financial structure as well as technological evolution. So all of that is going to come here in the next few years. Most of the financial landscape was set up really after, 1929, 33, 34 Act. Banks in the U.S. and the West formed around those structures, and a lot of the technological change it has the potential to really change that dramatically.
Well, as we laid out, you've invested in many moments of disruption, be it Goldman at the dot-com boom and bust, be it JP Morgan and HPS during the financial crisis. This moment of change right now, does it compare to the scale of those disruptions?
I think one thing you learn is every disruption is different. I think a few of the things that you have to watch, again, I was in Germany in 1990, so the wall fell in 89, 90, and then as you get into the 1999 buildup for the dot-com and then into the financial crisis as with part of JP Morgan, leverage in the system, you have to watch that. We've been very conservative with leverage in what we're doing. I think, those are themes that come out. Matching assets and liabilities and matching structures so that you don't have a liquidity mismatch. I do think what's different today, the banks are, I think, very healthy. You heard Jamie Dimon, you hear other bankers talk. I think the banks have remade themselves after the financial crisis. Obviously, we recapitalized the banks in the U.S. In Europe, they've shrunk a bit. But they're very healthy, so that's a positive sign. And then I think the CapEx cycle that you mentioned is something that has put the economy in pretty good shape here. So if we are going into a period of disruption, I think those two things are at least positive to keep.
So where do the concerns of leverage in the system come from then?
Well, I think that a lot of the leverage has moved to governments. So you've seen Scott Bessent and others try to really make sure that we're growing the economy and that the world is growing to keep pace with that. And then you've seen the labor dislocation that may come out of technology. We don't know where that'll go. That creates political upheaval and can rattle financial markets. Right now, I think the financial markets are behaving, some would say pretty surprisingly how we're managing through what is a pretty significant turmoil, obviously, in the Middle East.
Jamie Dimon, though, you mentioned them. He did say, along with the health of JP Morgan, he's worried about others seeing risky lending that echoes back to pre-2008. Do you not see any of that then?
No, I would agree with that. I would say, listen, Jamie has been a close friend and one of the best mentors and leaders I've seen. And I think whenever you see things, you want to tell your organization to look closer, make sure you're very disciplined, be a good fiduciary, be a good risk manager, and we all will have our moments. Everybody that has spoken at this conference will have their moments. And you just have to make sure that you're doing it better than, the others and trying to show the dispersion that will come out when you do have those cycles.
I guess what I'm trying to understand is if there is a disruption, where it comes from. Is it from government then, because they're over-levered?
Well, I think that for what we do, I think obviously, private credit there has grown significantly. So we've grown from like 300 billion back when I first started, maybe in the 90s to now, what, 2 trillion. And I know, Mark Rowan was quoting more like 40 trillion if you include all the private high grade. Anytime you have an industry that grows like that, there will be pockets where things are more difficult. I think that the areas that we're watching are smaller companies in the U.S. in particular. So if they're smaller companies, it's harder to deal with tariffs. It's harder to deal with labor and with rising interest rates. So there you may see some poor performance. That doesn't necessarily mean that creditors or lenders will lose money, but it may be more difficult. And then pockets of software, everybody's been worried about how will that play out. I think there was a lot of capital that was put in from very smart private equity and very smart institutional investors into software, really in the 21-22 vintage that was pretty highly priced. And that, as that works its way through the system now, 4 or 5 years in, you may see pockets there. But I also think that the need for income people want income in their portfolio, and they can get that in many ways. You can get that from the treasury market. You can get that from a bank. You can get that from high yield right now is pretty good. High yield has very little exposure to software. And then you can get it from private credit, where you maybe get more return and a little less liquidity. And so that, I don't see that going away. In fact, I see investors wanting more of that and wanting it from real estate, wanting it from real assets.
There have been some, and Bruce Richards among them from Marathon, now part of CVC, who will be speaking at this conference, saying that the issues with software harkens back to 2016, what happened in energy markets, that oil prices go negative, energy credit is an issue, and it has a wider spillover effect. If there is an issue with software and you start to see defaults pick up, are you concerned that it might have wider ripple effects, or do you see it as very confined to the sector?
Well, I think the comparison to energy is a little different, right? You had a commodity risk that is very hard to hedge. So we don't do a lot of commodity lending.
Sure.
And that's a different business, really, and a different risk profile. I think on the software side, you will see, again, same themes, smaller companies, models that are easier for AI to disintermediate will struggle. Obviously, every owner of a software company will try to morph that. So I think it'll be more dispersed amongst managers. Some will have done more. And again, it may be as private credit was growing during that 21-22 period. There was a lot of activity. People were trying to grow their businesses, and there now may have some of those loans that they have to make sure are going to become due. And if they struggle, then those firms are going to struggle.
So if the pockets of weakness are smaller, mid-cap companies and software, does that have any other economic ramifications? I think especially of small companies in America being the biggest hirers among the population. If those are the ones that are in trouble, is that a problem for wider American markets and economies?
I think the pace of technological improvement and the productivity improvements feel like the U.S. economy is going to grow its way through this. And obviously, you may have pockets of labor dislocation that will be hard politically, and we all have to work to make sure. In my career, again, over 40 years, I've seen as we get more technology, we need more engineers, we need more people to do more things, and I still am cautiously optimistic that we're going to work our way in that direction. But it's certainly a big technological change, bigger than anything I think we've experienced.
So if it's a moment of disruption, the pace of change is accelerating, be it technology or Western capital markets. When there's dislocation, there's opportunity. Where are you finding that opportunity right now?
Well, I think the interesting thing, and with some of this change, there has been some volatility. You've seen it in the equity market pockets and in the credit markets, where maybe because of some of the concern, the opportunity set is getting better. We've spent really the better part of 17 years being pretty conservative, tried to stay low leveraged, and so in a moment where maybe there is some dispersion, that's going to create opportunity. I think we see opportunity for the bigger players. So part of BlackRock now, being a scaled player, we're running a business now about $400 billion of capital across a variety of different lending activities or financial activities. And in that, we're seeing both borrowers and LPs want to work with partners that can be reliable, where you can be fast with capital, you can commit to them, you can deal with complexity. And then on the LP side, they want to see, we're fortunate to have a variety of different places where we can show them, this is your risk return, this is what we have in high yield, this is what we have in private credit, this is what we have in solutions, and you can bundle that in a portfolio that makes sense. And I think those trends are accelerating.
What then happens to middle market players who not only can't participate in that, but have lent to the smaller companies that, as you say, might have issues?
I think there will, as there always are, there will be middle market players who do very well. And then broadly, if your business, again, in credit, what we've always wanted to have a very wide funnel. So half of our business is non-sponsor, half is sponsor. Most of the middle market players and a lot of the players focus only on sponsor lending. So that limits them to sort of, and when they're just doing what they see, that creates a little bit of a problem. If I'm just doing middle market and then middle market goes bad, that's likely to not go well for the portfolio. If I'm just doing software lending and that goes bad. So I think you really want, and people like Mike Milken and others have talked extensively about portfolio construction, conservative building of the portfolios. That's what's going to carry the day.
So you mentioned the integration now into BlackRock, getting that scale, announced late 2024, finished July 2025. How has that gone? What has integration been like?
Well, where we left the other day, I think Mike Patterson and Scott French and I were saying we've worked as hard as we're ever working. Coming into a big organization is very exciting. I think, as I said at the beginning, BlackRock's footprint, and one of the things we wanted to get out of it was really the origination opportunity with everyone. And I had this a little bit at Goldman and JP, where we now, when any borrower in the world should want to talk to us about what can we do. That's working. That's taken a lot to really get going. And I think we're just in the early innings of that driving. I do think, and I think somebody might have said this on stage yesterday, the shortage is origination in these businesses, finding good assets and then being able to structure them and deliver them into managed accounts for LPs in a way that they have low single name risk. So that part's been good. And then what we've done with creating a $400 billion boutique within BlackRock, if you will, I actually think we've streamlined it. Like sometimes in business, you take big things and put them together and simplify it. And I think we've really simplified it for both borrowers and our LPs in a way that, but it's been work, and it's going to continue to be, a fair amount of work, but very excited about it.
How do you see the existing BlackRock credit business? Because it does feel very different than yours. More middle market, mid cap companies versus, as you say, the split you have tends to be more kind of large cap.
Right.
How do you make sure that you can meld the two? How are you thinking about that?
There's been very little, overlap. I think in the middle market business in the U.S., I think there's been a little bit of overlap, and again, that's been a business with the companies growing less quick that you have to really be very disciplined right now. So we've been doing that, and I feel good about the team. Mike Patterson, Vikas Kaswani have done a great job, trying to streamline and integrate that. In Europe, they had a middle market business that was pretty standalone and was very, very successful. I think that is also then people are able to say, hey, if I've got a bigger deal, I'm mining for my middle market. If I get a bigger deal, I get to do that. That gets to be positive, and you get those positive benefits of having many different pieces of business together. So
I do just have to ask, because there was one of the BlackRock funds, one of the BDCs that was marked down 19% to NAV. Again, a legacy fund, not one that you brought in. How are you managing that right now?
I think that there are pockets where you have to take a look at what the portfolios are and really take a look at how to continue to evolve there. That's a traded BDC. Right. So a lot of people don't know the difference. Some are traded public but non-traded, and then that's a traded BDC. So what you're talking about there is the portfolio took a mark, and then the shares are traded in the open market. And you just have to be a good fiduciary and a good risk manager, and in that one, we're trying to help continue to drive what's right for both the borrowers and for the investors.
By the way, I did do my homework. HLend, which is a non-traded BDC, you had your marks at the end of this year.
Yes.
And staying very steady there, marked of only 5 cents, very, very negligible. There have been other BDCs, though, that have reported that have seen some discounts to NAV. Is what we're seeing now, and you're talking about the risk management, is it signs of stress, or is it just a return to historical norm after a period of low rates and maybe easier returns?
Yeah, I think you're hitting on something that is hard for the press and hard for media to really understand when, you see defaults, you see things happen. We were in a period of very low defaults during when interest rates were very low during COVID. Coming out of that, you are returning to normal and getting to more of a 3.5–4% default rate. Again, what matters in credit is not defaults, it's losses. We've had a very good history and track record of doing that, of building big portfolios with very low losses, and we're super proud of the business we built. And again, I think as we see more dispersion, we're going to show how that performance and how that fiduciary focus, risk focus, low leverage will hopefully shine.
Sometimes, though, returning to the mean can feel painful for people who got used to lower rates, especially as the industry starts to push into retail. Do those two projects come into conflict with each other, of trying to bring more outside capital in at a time that, yes, it's just a return to the norm, but you start to see defaults pick up?
Right. Well, you mentioned Jamie. I mean, Jamie did say, anybody can make a loan. Not everybody that makes loans will go well. That's true. We also have a group that focuses on, and if loans do go bad, we need to be able to go in and take over the company, be able to manage that to optimize the return. Not every firm has that. Not every firm has the scale to afford that or the talent to do that. And I think that's something that will differentiate people. If you're just saying, okay, I'm out, then you're going to have much larger losses, and that's not going to be good.
It feels like just even more consolidation, Scott. If you have companies, if we remember the mid-cap players, you said, yes, some of them will do well, but maybe they don't have the teams to take back the keys. They're already dealing with companies that are under stress. The consolidation that's underway, just how dramatic are we going to see this evolve over the next 5 years, let's say?
Well, it'll depend on performance, right? Yeah. I think that back to what you were saying too, there were periods where I mentioned 21 and 22 where software was very hot, firms were growing their business and wanting to lean in, and there is a little bit of okay, we wanted to grow. I think most of the big managers are very good at managing risk, and the scaled players are going to continue to benefit from this period. I think when you have less scale and you're doing more niche-y, what do I see? I'm only seeing a limited thing. That's a tougher spot to be, and I think those players will struggle. But again, they can have a business that's small. It's not going to be what I was talking about in change, the restructuring of the capital markets and big pools of capital. That's a different game that they're playing.
Scott, I'm afraid we are going to have to end it there. Thank you so much for joining. This was a beyond fascinating conversation. Everyone, please join me in thanking Scott Kapnick.
Thanks very much.
We thank Scott as well. Scott Kapnick, their CEO of HPS, with my co-anchor, Dani Berger. She'll be rushing back to set to join me. You can watch, by the way, all of the Bloomberg Invest panels. If you've got a terminal in front of you, type LIVE, go, live, go on your terminal. And, of course, we'll break the most important headlines for you right here on Bloomberg Television. Check on what's going on in markets. We have risk on, the S&P gaining 0.8% right now. Nvidia rising. That helps NASDAQ rise 1.5% as it's more heavily weighted there. NYMEX crude right now is down 0.5%. It's been swinging back and forth between gains and losses, holding right in the $74 band. And Brent also the same, just a few dollars higher at 82. You see the U.S. 10-year yield right now at 4.0824%, and that's also holding in pretty much the band that we saw yesterday. The real action in bonds was in treasuries, at least on Monday. Global investors are navigating mixed signals about the war in the Middle East. Here's what we've heard from guests at Bloomberg Invest so far.
This is going to be really, really hard, and I just think market participants are dealing with an enormous amount of uncertainty.
Right now, it's just too soon to know what imprint this has on inflation and for how long.
Inevitably, the world that we're living in may change geopolitically. We may see realignment of alliances. Energy prices has a big impact. We may see inflation come back in.
Woke up, or the market opened up down 1,100 points, and now it's come back. It speaks to the resiliency and robustness of the market.
Joining me now is someone who prices this kind of risk for a living, John Doyle, President and CEO of Marsh, a global risk advisory firm in the insurance business. John, so it's great to get your take. And I first want to ask about the Strait of Hormuz, because President Trump has talked about, you know, the U.S. military escorting ships through there and also trying to ensure some of this cargo transit, 20 million barrels a day, a fifth of the world's oil supply. What do you think about the possibility of insurance there?
Well, good morning, Matt. It's good to be with you. So insurance markets have, have largely stopped, at the moment. But, of course, ships aren't moving through the Strait at the moment either. So we welcome the administration looking to support the market. I don't think it's the clearing issue at the moment to get ships moving. Ship owners want to see de-escalation in the area and a level of safety and security. They can be comfortable, in sending their teams into the Gulf. And so, but we have experience in these types of situations from the past. So in the Black Sea, for example, as the Russia-Ukraine war heated up, shipping ceased. We worked with development banks in the area, developed a program to get particularly grain moving through the Black Sea again. And so we worked with other development banks, other governments, and so we reached out and connected to the administration to try to help with the situation here.
So you have spoken with the administration on this specific issue. How could Marsh help, and what do you understand the president wants to do in terms of setting up an insurance fund?
Well, of course, he wants to get oil primarily moving again, and so it's an important part of the world economy and global economy, and certainly for the region in the Middle East. And so we're here to support that effort. But as I said, it's the clearing issue at the moment isn't insurance, but we need to be ready to move as the situation de-escalates in and around the Gulf.
How do you deal with this kind of, well, you don't typically see this kind of event because it's a full-blown war with Iran and Israel and the entire GCC, getting hit. But how do you look through this as the CEO of a global insurance company?
Well, we're trying to help our clients navigate, all this complexity. And, this is my 40th year in business, Matt. This is as complex an operating environment that I think we've ever been in. It's an era of polycrises, and so things are changing and changing quite quickly. And the events of this past weekend are another level of uncertainty. And so we're working with our clients, helping them think through scenario planning, modeling, understanding their supply chain risk. We've got a range of tools, including AI-powered databases that help our clients think it through. But yeah, this is it's a new and and dynamic and fluid situation. But our clients need to make decisions. They're most focused on the moment and protecting their assets, including their people.
So there are obviously many different scenarios, many different ways this could play out. But how do rates look on the other side of this, or as we get deeper into it?
Well, as I said, there's not a lot of activity moving into the Gulf at the moment, but rates have moved up quite a bit, as you would expect insurance rates have. We'll see, as things settle and, as over time, it could become a safer, part of the world. And so we'll see ultimately what happens there. But getting capital to support the businesses that are trying to move goods, and it's not just oil, of course. There are many container ships stranded in the Gulf. There are a few cruise ships as well, and so we're helping asset owners of all different types navigate it.
What is your view on the private credit or the private markets right now? Because historically, it's been a place where insurers invest capital. It's been the argument is a safer place with better returns. Does it continue to look that way to you?
Well, private capital broadly is an important part of our clients' portfolios. We actually hosted a panel this morning, a panel discussion. Of course, there's a fair amount of discussion about private debt markets and what's happening there. There are winners and losers, of course, in any markets, and all private capital managers are not the same. And so it's one of the ways, of course. We have an open architecture model to our investment advisory business. We advise around 16 trillion of assets around the world, and so we're helping our asset owners navigate those markets. But we see a lot of opportunity in private, including private debt, but you got to have the right manager.
So, I mean, with that much with advising that much capital, if I were to ask you for a temperature of this market, what would you say it is? Because
well, I think asset owners are concerned, right? And again, anytime you see a concentration and so much growth in a certain market, there are going to be winners and losers for sure. Our asset owners tend to have a very long-term view. A lot of it's pension money, and so if we help them manage those risks appropriately, they're going to continue to allocate capital to alternatives.
All right, John, great to get some time with you. Thank you so much for joining us here at Bloomberg Invest, both on the panel and with me here on the television program. John Doyle there of Marsh. Now, coming up, Bruce Richards is going to join us from Marathon Asset Management. He's going to talk about navigating the crossroads in private credit as well. And just this morning, he put out a post on LinkedIn saying we could see as much as 15% in terms of a default rate on highly leveraged software companies. We'll get into that discussion with Bruce Richards next. This is Open Interest.
Jamie mentioned cockroaches. I think of this as jellyfish on a beach. I come from northern Spain, and every summer when you see the jellyfish on the beach, you still go in the water. You're just very careful. And we have been very careful for years, right? We have been on a risk-off for the last couple of years. We're very careful. Obviously, there's going to be sometimes you get stung a bit, but when you're careful, it doesn't matter.
That was Santander Executive Chair Anna Botín speaking with Dani about private credit fears, likening her experience with them to a jellyfish, so less of a cockroach. Our next guest says that highly leveraged software default rates could hit 15% in private credit. Joining us now is Bruce Richards. He's the chairman and CEO of Marathon Asset Management. And you just put out a LinkedIn post this morning. Dani and I were reading it before the program, likening what happened in energy in 2016, 2017, 2018 to what we're looking at in software now. Is it fair to compare those two industries? Because I think Scott was saying, hey, there's a different ball of wax here.
It is a bit different ball of wax, and Scott's right to say there's no comparison between the industries. But let me explain why I come to that parallel. So back in 2014, a new technological change happened for oil and gas. It's called horizontal drilling, or fracking. And that technological change did a couple things. Number one, it changed the pricing structure for how oil and gas services would work. And number two, based upon all the capital that was raised, now all of a sudden capital dried up because the pricing structure collapsed. And so what we have in software is very similar. We have a technological change which is forever going to change how software is going to be priced. Now we should think about that industry. And based upon that technological change and how much leverage is in the broadly syndicated loan market, and then more importantly in the direct lending market, leveraging up these software companies, the capital's now drying up. And so what did we see as a result of that technological change in oil and gas? We saw a 15% default rate in the subsequent years, 2016 and 2017. So for me to say that software, which is the biggest sector within the direct lending business, couldn't get to a 15% default rate, I think is actually missing the mark, because I think that's exactly what's going to happen in years 27, and it has a chance of happening in 27 and 28 to have back-to-back years. So although the industries are very different, there's a lot of similarities when it comes to technology, changing how pricing structure works at a time when too much capital has been flooding into the sector. Just think about this for a second, Matt. Only 1% of companies in the U.S. are software companies, and only 7% of all publicly listed companies are software. Yet, 23% of the direct lending business is software. How did we get there? It was a gold rush to finance these software companies and these buyouts. And the public companies are sitting in good shape because their debt, when you look at NASDAQ, S&P, Russell 2000, the debt that these software companies have with really good margins, the debt that they have is only 0.5, less than 1 turn of leverage. In the broadly syndicated loan market, you have 5 turns of leverage, 10 times the leverage. Right. In the direct lending business, you can have 20 times leverage, so you don't have the companies that can generate the free cash flow to reposition for AI. They're in a very tough position.
So, Bruce, what is the effect of that? I think a lot of investors are reading your research and starting to wake up to the fact that this could become a reality. And as a result, we're seeing redemptions. You know, people are trying to get out of these illiquid private credit funds. And what we see some of these companies doing, Blue Owl, for example, is, okay, we're going to sell a ton of these assets. We're going to sell these loans. And they want to be able to say, we got, 99%, we got 98% of the par value for that. So they can't be selling those 20 times EBITDA software loans, right? They must be selling their best assets.
So I can't speak to Blue Owl or others that
of course
have
not.
Liquidity crisis or liquidity issue right now in their funds. It's something I'm not focused on. What I am focused on is the availability of capital on the back end of this to extend these loans. And I believe that there won't be availability of capital. So I think the next round in the years 27, 28, when a lot of these loans come due, is in the direct lending business to extend and amend or extend and pretend to pick those loans because it won't have the cash flow.
Payment in kind financing.
And you won't you won't get paid back in interest. And because you've extended the loans, you also won't be getting paid back in principal.
What does that do to an entire industry that is both private credit and private equity that has loved software, that has gotten it to 23%? If all of a sudden they can't go to capital markets and they can't get those loans, the financing ceases to exist, what does that do to the industry?
I think the industry is fine because I think direct lending is a big industry, and I think that there are other sectors of the economy. Again, software is only a few percent of the overall economy.
But it sounds like you're saying software lending is over. It's done after this episode.
I think when you lend in software, you have to lend at very conservative multiple because the business itself is an uncertain business. And so 4 times debt to EBITDA, not 10 times, is probably the right number, and getting paid a little bit more for that risk, an extra 100 basis points on your loans. Now, to the extent that financial conditions tighten a little bit on this in the direct lending space because of what's going on, we can get paid more for loans that we're making in the marketplace with tighter covenants. So I think for lenders that aren't in a bad position, that actually can extend credit, it's actually a good place to be. And so I wouldn't let software, just like oil and gas, when you had that problem with those companies back in 2016, 2017, 2018, didn't tank the economy. The economy was just fine. I think the economy will just be fine without having to deal with the default rates that are coming, the problems that are coming, because the economy is so much bigger and diverse than this. And so it's not going to do anything to cause any kind of disruption to the broader private credit markets or the broader credit markets or the economy. I don't believe that at all is the case, but what it will cause is religion to come back in and discipline to come back in, because quite simply, Dani and Matt, 23% in software is just too much exposure to one industry group when it only represents a very small part of the overall, equity markets. It's only 1% of all companies in the U.S. are software companies, and only 7% of all publicly listed companies in the U.S. are software companies. So it's too much exposure for them to have had. Everyone regrets it now. We're thankful that we have 1% exposure and not that type of exposure. And it's going to represent some really good opportunities for us as lenders in the years to come, Dani.
Well, I'm wondering, where those opportunities are going to be, and specifically in software, because religion has already set in with some of these names. Are there some you think that are oversold? Are there some that you think, the debt is cheap enough to go in and pick it up? Because that's historically where you've made a lot of money, Bruce.
First of all, I think in the public equity markets, they're going to be in a really good position to buy a lot of this at pennies on the dollar, because they're the ones that are going to have the capital, the cash flow, the margins to be able to do so. Smart private equity will also come in and recapitalize and buy new companies, but they'll pay a lot less. The whole ratings of where, what multiples you pay for the company has come down substantially, and private equity traditionally doesn't pay more than 12 times for a company, traditionally. And so getting the whole sector repriced based upon this existential risk that you have Look, private equity is important, and that's where we're moving towards. And the second thing is private equity has all the upside. Imagine a company through creative destruction that they can reposition. Instead of making 2 or 3 times their money, they make 5 or 6 times their money. So they can afford a few zeros, right? And still come out okay. Private credit can't afford the zeros. They only get paid back par. They don't have the upside. So what you need, Matt, is certainty when you lend. It's an uncertain business right now, and that's why capital will not become available.
So are you not buying anything then?
Not right now in software. What we're focused on are businesses where Halo is the effect.
Hard
I'm talking
assets.
about hard assets, low obsolescence. I'm talking about in lending, our last private credit lending deal in DL was a concrete deal with rebar. The deal before that was sod for commercial and residential that you lay on the lawns, right? And so these are real asset lending opportunities. And our last asset deals in our ABL business, hard assets, low obsolescence, are aircraft, maritime assets, turbines, cranes, and engines.
Because you're bullish the economy.
Because we love the economy, and we want to be able to lend, say, on a $300 million asset pool, $200 million on an LTV basis, a 66% LTV, that nice margin of safety with that hard asset where we have a perfected interest in that hard asset. It's not software where the recovery value will be close to zero if there's a default. We get full recoveries in the event of a default on most of those assets. And we very rarely have a default because they're missing critical assets for these companies. And so it's a very different dynamic when you talk about Halo. And with Halo, that's why you see industrials and materials up 25% in the year, when a lot of the software companies are down 25 to 40% in the year when you talk about the mid-market software companies. And so we're in a very good position at Marathon as a lender with capital available to lend and with how our position is currently positioned.
All right, hard assets, low obsolescence, HALO. You get credit for the acronym, Bruce, and this has all been kind of a deep tease for our panel because you're going to go on stage with me right here at the Bloomberg Invest Conference in just a few minutes. And for those of our viewers who have a terminal on their desk, you can watch that, type LIVE GO to get more on this from Bruce Richards of Marathon Asset Management. Really appreciate you joining us, though, on live TV
Matt,
as well.
thank you. Dani,
Thank you very much,
you.
Bruce. And we have exciting program continuing throughout the day, including a special edition of Bloomberg Deals, which airs every Wednesday at
Wednesday.
noon. It is Wednesday. I'm going to speak with heavy hitters, including KKR co-CEO Scott Nuttall, Gabelli Fund CEO Mario Gabelli, and Victory Capital, who's trying to do a hostile takeover of Janus Henderson. That kicks off at noon Eastern. This is Bloomberg.